Hi everyone. So today is our third lesson for investment analysis. And in our previous lessons, we were able to cover capital structures as well as bonds. And today we will be moving towards one of the most important parts, which is equity. So yeah, so now let's see what equity is. So equity can be generally defined as like the part of funding which can be attributed to the shareholder. Or there can be like multiple amount of equity sources. One is the main source that we all know about, which is the share capital. It could also be like reserves. So equity is generally obtained. We know that it is generally obtained by new share issues to kind of like new investors. And and one of the things that we all of us know is the shareholders are generally considered as the owners of a particular company. However, one of the things that we need to understand is, even though the shareholders are like the main owners of the company, they generally don't get involved in the day-to-day operation. For that, they appoint a board of directors who are generally considered as agents of the shareholder, who are who have the authority to carry out the day-to-day business activities. So, and when it comes to equity instruments, we need to understand that it have the indefinite maturity period, and they obviously don't have a fixed repayment as such. They have um like it is based on like the dividends, which could differ. Sometimes they might not get dividend payment as such in certain situations as well. So because equity holders are the owners, they bear kind of like the huge, a very high percentage of business risk. Therefore, that's why we call that the equity shareholding has one of the highest risks as well as the cost of capital. I think we were talking about it while we were talking about debt. We did like a comparison. So they have a huge part of business risk involved. So now, moving on, we'll be talking about different terms associated with equity. So one of the terms that we generally talk about is nominal value. So what is nominal value? This is basically the face value of any issued share. And there's another word that generally are used when we are talking about equity, which is issue price. So now what is issue price? This is basically the price or the amount that the company can get for like a freshly issued share. So this does not necessarily mean it is the nominal value or the face value of the share. It could differ. It could be higher than the face value. It could be lower than the face value, depending on what type of company is issuing this particular share. So another term that is generally associated with equity is market price. So our market price is basically the share value at the current market rate. So this is basically determined by the demand as well as the supply forces for that particular shareholding. And basically market price is the price that is going on as currently at that particular period, which would obviously be different from the face value as well as the issue price. So share capital. So basically, company raises share capital by issuing share for like a consideration, and like there could be different types of shareholdings. And generally, you need to understand that the equity shareholders are the owners of the company. Therefore, even though they don't get involved in like the day-to-day operations of the company, they have voting rights. So in meetings, they have the right to vote in favor of a proposal or kind of like a decision based on the company. And another thing that we need to understand is generally these ordinary shares are issued with like a nominal value, and the book value of the equity is generally the sum of these ordinary share capital shown in the balance sheet plus the value of the shareholders' reserves. And market value is simply the share price multiplied by the number of shares. So as I told you, it is basically the current value of that particular share in the market. Therefore, it is the share price multiplied by the number of shares. Moving on, I'm going to talk about a few more concepts that we talk about while we are talking about the section equity. One is right issue. So now what is a right issue? So share right issue protecting the rights of existing shareholders is called like a right issue. That means when new shares are to be offered, the existing shareholders get like a proportion of the existing ownership. This will generally help to maintain the existing share of the ownership and control of the company. And so basically when a new share is going to be issued, what happens is the existing shareholders get a particular right to buy a specific amount of shares from the company before the others. And the right issue, one of the most important things is that the right issues are offered to existing shareholders for a price which is less than the market price of the particular share. So that is what right issue is. And ordinary, now we are moving on to talk about ordinary voting shares. So now let's see what ordinary voting shares are. These are basically, they generally don't have a maximum limit for their return or even their risk. So one of the key features of the ordinary shares is that they, in a wake of a bankruptcy, what happens is the ordinary shares may receive their funds invested only if there's something left after paying the debenture holders, the preference shareholders, and even paying all the creditors. Therefore, they have quite a high risk. So that is ordinary voting shares. So there is another category called ordinary non-voting shares. So non-voting shares are similar to voting shares except for the voting rights. So due to this lack of voting rights, non-voting shares are traded at a discount to the voting shares. And generally, if you look at the dividend yield, obviously it would be higher for the non-voting share. Then there is another, kind of term that we use when we talk about equities, which is called deferred ordinary share. So now what is a deferred ordinary share? So this is basically right of an ordinary share, which is deferred until like a particular period, or let's say, or even a condition which need to be fulfilled. So it can be difficult to find an investor who could agree to this particular condition, like whether it has to be, it could be a condition or even a period. So that means it will be a little difficult to find someone who would invest on it. And then we were talking about reserves. So reserves generally belong to the shareholders, and they are generally considered as the shareholders' funds because however, we need to understand this source of finance is not very significant because this is not represented by cash. So what happens is, a particular profit area is kind of used as reserve, or kind of put in as reserves instead of paid as the any type of payment for the equity shareholders. However, this is not in cash. So therefore, the usage for usage, it will be a little difficult for a company. However, if the cash is available, this should be a preferred source of equity due to the low transaction cost, and also this reserve could include share premium, revaluation reserves, or like other types of reserves, or even retained earnings. Now, we're talking about financing. If we talk about financing through equity, one of the key alternatives which we should understand is satisfying long-term financing requirement. So equity generally takes a different forms. Financing through, it could be ordinary voting shares, it could be non-voting shares, it could be deferred shares, or even reserves. So these are the things that we were talking about. And another thing that we need to understand is that ordinary shares have a great risk. So because they don't have any legal claim for return, and ordinary share value could be referred as a par value or book value or even a market value, which we were talking about. And if we are talking about the cost of the equity, we need to understand that the cost of equity would obviously be higher than the debt because of the high business risk that they need to bear with. So talking about cost of equity, the way we consider this is called KE. We use KE into formulas. The cost of equity holders are generally like owners of the company, and they have a higher level of risk. And the last preferred set of investors when paying out dividends, as well as even during liquidation, because of the high level of risk involved, they generally require high rate of return, and therefore it increases the cost of capital of the company. And there are generally a lot of ways that are used to estimate the cost of equity because it's kind of high. So cost of equity, there are two main methods that are used. One is called dividend growth model, which we'll be talking about. So basically, dividend growth model, what is it? It's basically like a mathematical model used to calculate the cost of equity. So when we calculate the cost of equity, this consider the growth rate of the dividend paid by the company. So one of the main things that this particular model considers is that it is assumed that the growth rate is constantly growing till perpetuity. So one of the things that that the dividend valuation model considers or even states is that the dividends will be constant, or it will be growing at a fixed rate. That is one of the notions that is considered. Then that the dividend will be paid in perpetuity. Thereafter, there is something where they say that the share price equals to the present value of dividend paid in perpetuity. So that is one of the things that is considered in dividend valuation module. So as you can see here, the current share price according to this module is that you get the constant dividend from year one to infinity divided by the required rate of return, and they believe that is what the current share price is. Moving on, we'll be talking about cost of equity under the dividend growth model. Now, according to the dividend growth module, look at the formula. This is the formula that we will be using in order to calculate the cost of equity. So as you can see, cost KE is the cost of equity and DO is the dividend declared today or during the year. Okay, and inside bracket you get 1 plus G. G is the growth rate. So basically, as I told you, they consider under this model, what they consider is that the dividend will be constantly growing at a fixed rate. Therefore, 1 plus G, which is the fixed growth rate, and it is divided by PO, which is the current ex-dividend market price of the share. And this PO, as you can see, is how we calculated. We calculate the dividend from year to infinity divided by the required rate of return. And this, for this, you add the dividend growth rate again. This is how we calculate the cost of equity according to the formula. And now let's look at an example to understand how we can calculate DGM, or the dividend growth model. So as you can see, the question says the following information relates to X Limited. So expected dividend growth rate according to the question is 4%, and the dividend which is currently paid is $5, and the current ex-dividend market price of share is 50.5. So ex-dividend market price of the share is basically the PO that we were talking about. So when we are calculating the cost of equity, as you see, KE would be DO. DO, as you can see, is the dividend which is currently paid. So we as you can see here, we use 5 instead of DO, and we add 1 plus the growth rate. The growth rate is 4%, which is 0.04. And then we divide it by the current ex-dividend market price of the share, which is 50.5. And hold on, we add the growth rate again, which is 0.04. And as you can see, when we calculate this, you get a KE, which is 0.1429. And when we consider this as a percentage, it becomes 14.29. So accordingly, as you can see, the cost of equity here is 14.29. Just hope you understood. This is basically how we calculate the KE based on the dividend growth model. Now, moving on, we are going to talk about different types of instruments related to equity. Another instrument that we are going to talk about is the hybrid instrument. So we were talking about hybrid instrument even before, where we said it could be a mix of equity as well as debt figures. And one of the main types of hybrid instruments is the preference shares and even like convertible bonds. So so these two are the key instruments which will fall under hybrid instruments. And hybrid securities generally offer invested kind of like a return until a certain period of and then generally it provides like a variety of options, such as like converting debt into a share, something of that sort. So first, now I talked that I said that there are two types, which is preference shares and convertible bonds. I think we talked about bonds a bit before under the bond section. So let me just speak about preference shares. So preference shares they are like entitled holders to get a fixed rate of dividend. So now the difference between a preference share and an ordinary shareholder is that ordinary shareholder does not have a fixed rate of dividend. It depends on the situation of the company and declaration of the dividend rate. However, the preference shareholders will get a fixed rate of dividend, which is kind of similar to like the loan stock. So these dividends would be paid before the ordinary share dividend, and preference shares carry part of the ownership of the entity and generally allow due participation in the entity. So now let's look at the advantages as well as disadvantages of equity finance. So what are the advantages of having an equity finance? So one of the main advantages that we need to understand is that the repayment of the equity is not necessarily with bankruptcy. And also there is no collateral needed to raise the equity finance, and business will not have any cash flows related to equity finance because there's no necessity for the business to, legally pay back the equity holders unless like a dividend is kind of declared. And so now here you need to understand, when I talk about advantages of equity finance, we are actually talking from a company perspective. So even during bankruptcy, the company doesn't need to repay the equity holders. That's why we call it an advantage. And there's no collateral for the company. For the company, therefore, it's an advantage for the company. And there is no cash flow related to equity finance. So that means there is no legally binding kind of necessity for the organization to pay the equity finance, even if they have like a loss. So disadvantage is that it dilutes the ownership of the business, and dividend payments are not tax deductible. So those are the two disadvantages. We have to look at from a company's perspective here to understand the advantages as well as disadvantages. Now moving on, we are going to talk about cost of debt and so depending on the source of finance, the cost of capital could generally vary, and it could be computed for different financing sources. So cost of capital will depend on the investor's expectation of return. So when it comes to higher risky classes such as equity, return expectation should be higher compared to debt, where the equity is lower. So with that, we are going to talk about weighted average cost of capital. So what is weighted average cost of capital? Before that, we'll just, move on with the process of understanding, okay, right? Now, when it comes to a company, which is generally a company is financed by, it could be by debt or equity. So what is weighted average cost of capital? This is basically the average of financing cost of these two sources, each of which is weighted by its respective use in a given situation. So when we look at the cost of capital, we have to see that the company, from a company perspective, what happens is the company need to understand how much of equity do we have, how much cost of capital there is related to, and how much debt is there, and how much cost of capital is there related to it as well. And so a company's the WACC, or the weighted average cost of capital, is generally overall required return on the firm as a whole, and usually it is used internally by the company directors to kind of determine the economic feasibility, or even to things such as expansionary opportunities, mergers, or even like project proposals. For all these, the WACC is kind of used. And the WACC is like the appropriate discount rate to use for cash flows for risk similar to that of overall firm. And it is mostly appropriate discount rate, since the most companies tend to use a mix of all sorts of discussed earlier, and that gives a better idea about the overall business of the company. So now we need to understand, okay, I said what weighted average cost of capital is. Now we need to see how is this cost of capital calculated. So if you just talk about it, it's a single cost of capital measure that takes into consideration the demands of all types of capital provided to a firm, which includes debt as well as equity. So when it comes to the formula, as you can see, WACC, you get the weight of debt. D is the debt. And as you can see, it says 1 minus T. So obviously debt, we always talk about the debt having this cash deductible. We consider that. So when we are considering the weighted average cost of capital, we will consider this tax deductible section, which is the debt, and then the weight of the preference shares. So this is the cost of capital related to the preference shares. Then WE is the equity weightage. So if I'm talking about this, what each section means, when it comes to WDU, WP, or WE, it is like the weight of each section, like the debt, the equity, as well as preference shares, respectively, related to the capital structure. And the RD, now, here as you can see, there is something called RD, RP, and RE. So RD is the pre-tax cost of capital, cost of debt, because with that we include 1 minus T. From that we will consider the tax deductible RD, or the cost of debt after tax. And when it comes to RP, so the cost of preference share is included in RP. The cost of equity share is included in RE. So basically the cost is multiplied by the weightage of each section to identify what is the mix of capital that is involved here and what is the cost for the company. So moving on, we'll just talk about cost of debt. So when there are a number of different techniques that could be used to measure the cost of capital debt actually in a capital structure. We spoke about them. Actually, we talked about yield to maturity of a traded bond, and also when the bonds are not listed, debt rating approach can be used. And under this technique, the analyst studies the YTM of the bonds with similar rating, and the cost of debt is calculated. Cost of preferential, what happens is it is calculated. Preference dividend is calculated based on by dividing the preference dividend from price of the preference shares. From that the cost is derived. So now moving on, we are actually going towards another section, which is derivatives. I need to talk about derivative, which actually we've talked a little about it as well so many times. As you know, derivative is like a type of security, which is in which the price is kind of derived from one or more underlying assets. And it is like a contract between the parties involved upon the assets, and one of the most underlying assets would be like a stock, a bond, commodities, it could be currencies, or even like interest rates, or even market indexes. So derivatives are generally traded over the counter, or we call it as OTC, as well as on exchange. So when it comes to OTC derivatives, it's generally having a greater risk for the counterparty than do standardized derivatives. And we are going to try and understand more about these derivatives. And before that, I will be talking about a certain type of derivative, which is a swap. So this is basically a derivative contract through which two parties exchange financial instruments. So these instruments can almost be anything. And most of the swaps kind of involve cash flow based on notional principal amounts that both parties kind of agreed to do. So most common kind of swap is like the interest rate swap, and they do not trade on exchange rate, and retail investors generally don't engage in this swap. They rather what happens is the swaps are kind of over the counter contracts between the businesses or a financial instrument. So that is a type of a derivative, a swap. And moving on, we'll be talking about futures and options. So now what is a future? So basically futures are kind of like financial contracts which is kind of obligating a buyer to purchase a certain asset or the seller to sell a certain asset. So it could be like a physical commodity or kind of a financial instrument, or it could be like a predetermined future date, and it could have a price as well. So futures, when it comes to futures, we need to understand that the detail and the quality detail of the quality and even the quantity of this underlying asset, that they are kind of standardized to facilitate the trading on like a future exchange. So some future contracts may call for like a physical delivery of the asset, while the others are generally settled in cash. So generally future involves like buyers to kind of purchase an asset or even sell an asset to a physical commodity predetermined future kind of date. So when it comes to options, it's a little different. So options of a future contract generally gives the holder the right to enter into a specific future contract. And when the option is kind of exercised, what happens is the initial holder of the option would enter into the long side of the contract and would generally buy the underlying asset at a future price. And like when it comes to a short price, what happens is the future contract kind of like get the investor to enter into a future contract, or as like a short could be required to kind of sell the underlying asset on like a future date or at a specific price. So that is futures and options. Okay, moving on, we are going to talk about efficient market hypothesis. Now, efficient market hypothesis. First, let's see what market efficiency. So, so market efficiency is basically the degree to which like each stock prices respond to all types of relevant and available information. So if you talk in kind of like a different, in other words, what market efficiency means is that, when it comes to efficient market, one where the market prices are at an unbiased estimate of the true value of the investment, this is considered as market efficiency. So generally, so this market efficiency is kind of needed to ensure that the investor confidence to reflect like a company's performance. And so like we need to also understand that the efficient market hypothesis, so that we need to understand that it states that all relevant information is immediately and fully fledged into the market prices. So generally, when we talk about this efficient market hypothesis, the investors will not be able to earn like a abnormal return by using this, or which like the market is already aware of. So that is what efficient market hypothesis means. So when we talk about efficient market hypothesis, we need to understand that there are three forms of efficient market. So one market is basically called as the weak form. Then the second one is called semi-strong form. And the last one is called the strong form. So there are three types of efficient markets. One is the weak form, then the semi-strong form, thereafter the strong form. Moving on, we'll just try to understand what each form means. So weak form of efficiency is where in a weak form of efficient market, what happens is all past prices of stocks are kind of reflected in the today's stock price. So therefore, the technical analysis cannot be used to predict and even to beat the market. So that is why you call the weak form of efficiency. Then there is semi-strong efficiency. So basically, when it comes to semi-strong efficiency, in semi-strong efficient market, the share prices reflect all past and publicly available information. And because the published information generally includes the past share prices, a semi-strong form efficient market is also considered as weak efficient. So weak form and then semi-strong. Now we are going to talk about the strong form of efficiency. So in a strong efficient market, what happens is the share price reflects all the information in the market. So you need to, in weak form, all the past prices of stocks are reflected in today's price. And when it comes to semi-strong, the share price reflect all past and publicly available information. But when it comes to strong form, share prices reflect all information in the market. So it can be publicly available information, it could be privately available information, or it could even have the insider information. Moving on, now we said that when it comes to strong form of efficiency, it could be publicly available information and private information, which is included in semi-strong efficiency. We also said that insider information will be included as well. So now what is insider information or even insider dealing? So we'll just try and understand what that means. So insider dealings can be generally described as the making decision or gaining advantages on securities. Sorry. So insider dealings are generally described like making kind of like decisions or kind of getting any type of advantages on securities with access to non-public information about companies. So this may damage investors' confidence. So these are like inside information. And inside information generally refers to information about like the public issuer that it is not publicly available, that would or could even be likely materially affect the price of the public issuer securities, and if the information was publicly available. Now, we will be moving on to CAPM, capital asset pricing model. So moving on, capital assets pricing model generally kind of demonstrate the specific area to value a security. So now generally when it comes to this model, it emphasizes on like the effectiveness of the security by comparing it with the market, and it compares the risk of the security against the risk of the market to determine like the effectiveness, and the securities are identified from the security market line, and the cost of equity using the CAPM can be calculated. So as you can see, this is the formula that is being used by the CAPM. According to CAPM, the cost of equity is RF the risk-free rate plus beta, and RM minus RF. RM is the market return rate, and RF will be the risk-free rate. So before talking about CAPM, let me talk about the assumptions of CAPM. So when it comes to CAPM, all investors are considered to be rational and risk averse, and that the markets are kind of perfect. And it also assumes that the investors can borrow and lend unlimited amounts at a risk-free rate. And it also assumes that all assets are definitely divisible, and also that it is kind of like liquid, and the investors have like homogeneous expectation from the asset return. And another assumption is that the asset return conform to the normal distribution, and is that the market is kind of like in an equilibrium. So basically, the total number of assets in the market and their quantities are generally considered to be fixed within the defined period. Moving on, I'm going to talk about the components of CAPM. So as you can see, beta, I just said there's something called beta. So beta is like the coefficient of the security. So beta generally measures the risk of one instrument compared to the other. So there are two types of risk attached to every investment. One is called the systematic risk, and then the unsystematic risk. So systematic risk is basically like risk of being in the market. So this cannot be eliminated or reduced by investing in like a portfolio, because it's a risk of being in the market itself. And unsystematic risk is a specific, it's a specific risk related to a company itself. So this risk can be reduced by investing in a diversified kind of portfolio. So now we'll talk about market return. So what is market return? So market return generally comprises of like the capital gains or the dividends. So moving on, I'll be talking about the advantages of CAPM. So when it comes to CAPM, one thing that we need to understand, there are no complicated calculation, because we actually have a formula and we need to kind of put everything inside. No thinking to involve. We can just put it to a formula and get an answer and kind of understand the CAPM amount. So also, since it takes most of the variables from market information, it gives a more reliable estimate of cost of equity. So here, one of the things is that it considers all the market information, which shows that it uses the most reliable cost of equities calculated using the CAPM. So when it comes to the risk and return, they are directly linked to the CAPM, because we are considering all these market information which are reliable. And this is another advantage is that it is useful for appraising specific projects. Moving on, we'll be talking about the disadvantage of CAPM. Again, I need to kind of try and understand that the CAPM, even the disadvantage, will be talking about the company perspective. So when it comes to the beta, it is used based on past information. So there is no guarantee that the future will be the same as the past. Therefore, it's a disadvantage for the company when they use it to a calculation. So if the company is not listed on stock exchange, historical data will not be available. So then it will be difficult to kind of calculate the CAPM if it's not a company which is not listed in the stock exchange. Now, talking about estimating the market rate, return rate, the risk-free rate and the beta values will generally be difficult. And in practice, the existence of a perfect market is not guaranteed by, which is the disadvantage of the CAPM. Moving on, another disadvantage is that it is less useful if the investors are undiversified. And in practice, the existence of a perfect market is not guaranteed. We can't say that we are living in a perfect market. Obviously, there'll be variation. Therefore, it's a disadvantage for calculating the CAPM because perfect market is one of the assumptions that are used in CAPM. So the model assumes that the investors own diversified kind of portfolios. So the only market risk is kind of considered here, which is a disadvantage. And lastly, we need to understand that it says that it assumes that all investors have similar expectation on the return assets, and this cannot be held true in practice. So that is the disadvantage of CAPM. And we will try to calculate the cost of equity using the CAPM. So in the example, as you can see, the market return is 8%. The government bond rate is 3%. The beta coefficient is 1.45. Now, what is the government bond rate? Generally, the government bond rate is considered a risk-free rate. We need to understand that because it doesn't have much risk related to it. So when we consider any calculation, as you can see, for KE, we have to take risk-free rate plus the beta of the difference between the return, market return, minus the risk-free return. So here, as you can see, what we do is KE equals 3%. Instead of risk, we put the 3% government bond rate here as risk-free plus the beta value in coefficient is 1.45. We include that, and then the difference between these two are taken. So the market return is 8% minus 3% risk-free rate. Sorry. So 3% risk-free rate, 8% minus 3%, 5% multiplied by 1.45 plus 3% becomes 10.25%. So the CAPM here would be 10.25. So lastly, we'll be talking about the regulations on trading securities. As you can see, hold on, we are going to talk about the regulations. So when it comes to regulations of securities, we need to understand these are determined by the respective stock exchange and the country's legal and even like the monitoring system. So attractiveness of any exchange market is generally maintained by providing like a efficient as well as regulated marketplace. And when it comes to a recognized investment exchange, RIE, the exchange also has to assure that the requirement detailed in the Financial Conduct Authority or the RIE and the RCH source book need to be considered. So when it comes to orderly markets, they're generally maintained via rules or even guidance as well as through the monitoring of trading and the market activity. And the stock exchange notices basically disseminate amendments to the rules and also the guidance. So the rules are generally updated in 2007 in readiness for the introduction of market in financial instrument directive, MIFID, or the directive. And one of the examples that we can come up with is the London Stock Exchange members who are bound to obey the rules and regulations of the LSE and ensure the compliance on all rules and regulations. This is all because all rules are closely linked to the trading system. With that, these are the references that you can refer to if you want. So moving on, I just want to kind of do a recap of the whole lesson that we have kind of completed during these 3 sessions. So first we kind of talked about capital structures, we talk about financial instruments, and then we said different sources of finance. And then we talked about bonds and how it's recognized, and like the initial recognition, thereafter about the subsequent measurement, or how it is included if there is a discount or even a premium. And then we moved on to kind of use recognition in 2 steps, how we include it in a balance sheet or income statement. Then we just spoke about debt finance, and we spoke different types of debt finance, where we spoke what is a debenture, what is a deep discount bond. We spoke about zero coupon bonds, then about bank loans and the euro bonds. And lastly, we talked about convertible bonds as well as the convertible warrants. And then we moved on to effective interest of a bond. We spoke about how it is preferred by US GAAP as well as IFRS. Then we talked about what a debt covenant means, how it could be like an affirmative covenant or even a negative covenant. We spoke about that, and then we spoke mainly about the risk, financial risk as well as business risk. And then we spoke about high levels of gearing and how it affects an organization. And we spoke about cost of debt. And we spoke about the redeemable debt, and we did a formula on it. And then obviously we did like an example for it. And then spoke about the advantages of debt finance, then the disadvantages of debt finance. Then we calculated the debt yield and the yield to maturity. And thereafter we spoke about term structures of the interest rate. We talked about yes. Then we talked about 3 theories related to interest rate. We spoke about pure expectation theory, liquidity preference theory, the market segmentation theory. Then we thereafter today we actually covered a long section where we talked about equity, different things like nominal value, issue price, and market price. And we just spoke what share capital is, and then we spoke about right issues and what ordinary voting shares is, what is non-voting shares are, and what deferred ordinary shares are. And we even spoke about reserves. Thereafter, we spoke about cost of equity and about the dividend growth model and what assumptions are used by dividend growth model. And thereafter, we kind of did an example of I taught you the formula for calculating the KE, or the cost of equity, and we calculated the cost of equity using an example. Thereafter, we spoke about hybrid instrument, and we said one of the 2 main hybrid instruments are preference shares as well as convertible bond. And we spoke about preference shares here. And lastly, we spoke about the advantages and the disadvantages of equity finance. Thereafter, we spoke about the cost of debt and equity, or like the combination of it. And we moved on to weighted average cost of capital and how to calculate it. We just explained how the calculation is done. And then when we moved on to derivatives. And then we spoke about a swap, what a swap is. Then we moved on to things like futures and options. Thereafter, we mainly spoke about efficient market hypothesis, where we spoke about market efficiency. Initially, we spoke about what market efficiency. Thereafter, I spoke about what efficient market hypothesis is. And especially spoke that there are three main efficient markets. One is weak form, then the semi-strong form, thereafter the strong form. So thereafter what we did was we did like a small explanation of each category, the three categories mentioned, which is the weak form of efficiency, thereafter the semi-strong efficiency, as well as strong form of efficiency. Here what we kind of understood is that in the weak form, that all past prices of stocks are kind of reflected in the today's stock price. So basically they say technical analysis cannot be used to predict the beat the market. However, in semi-strong, the share prices, they say that it reflects all past and public available information. Therefore, they consider that it includes past share price, and semi-strong form is considered to be weakly efficient. However, when it comes to strong form, they say that the share prices reflects all information in the market, which is publicly available, private information, and even insider information. Therefore, it is considered as strong form of efficiency. Thereafter, we spoke about what insider dealing is and said what insider information is as well. Thereafter, we moved on to CAPM. And we tried to understand how CAPM formula is calculated, and we said what risk-free rate is, that is the government bond rate. And then we spoke about the assumptions of CAPM. Thereafter, we spoke about the component where we talked about systematic risk as well as unsystematic risk. And thereafter, we spoke the advantages of CAPM and then the disadvantages of CAPM as well. Thereafter, we did like a sum where we tried to calculate the CAPM, and we came up to a cost of equity of 10.25. Here with the beta coefficient was given, that is used as the beta, and the RF or the risk-free rate that was considered was the government bond rate. Thereafter, lastly, we talked about the last topic of this particular set of lessons, which is regulation on trading securities. We spoke about them, especially took an example of London Stock Exchange and spoke about it as well. And here came, I've just included some of the references maybe that you could kind of use. And I hope that you understood our lessons throughout these 3 lessons. If there's anything, you could obviously contact me, and I just hope that you go through all the other related material to try and understand about investment analysis. And I hope that all of you get a good knowledge related to investment analysis, and you could obviously try out different type of sums to kind of see how it mathematically works. But I want you to also, after doing the mathematics side of it, I would want you to kind of try and understand why you made it and what the mathematical answer represents. Okay, I just hope to meet you in the next session during next week, and I hope that you covered these 3 lessons and understood what I explained, and I hope that you have a very good day. Have a nice day. Goodbye, everyone. See you next week.